Hello, I'm Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, I'm joined by Richard Hunter, Head of Markets at Interact Investor, to talk through his investment predictions for 2025. Each year, Richard comes up with an acronym that highlights the key things for investors to watch. So Richard, this year's acronym is digital. So could you firstly run through it and then we'll discuss each part of it in more detail?
Yes, digital. So we're talking about dollar, inflation, growth, interest rates. For T, you can take your pick between tariff, Trump and trade wars, AI reckoning, or is there more to come, and large caps versus small caps, and that includes the umbrella of M&A activity.
Right, so let's get straight into it. So the first part of the acronym is dollar. So could you talk us through why you've chosen dollar as a key area for investors to watch in 2025?
Yeah, there's been a delicate balance between growth and inflation, and we've still got the greenback's reputation as being a haven asset. That's sort of kept the dollar price fairly strong in 2024. Now, should the new administration deliver on its pre-election promises, one of the outcomes could be a reduction in the pace of interest rate cuts, which, all things being equal, would be supportive for the dollar. And indeed, the foreign exchange market specialists are very much predicting further strength in 2025 in terms of the dollar. Might be worth mentioning at this stage that sometimes we forget perhaps that in theory that should be or could give an indirect benefit to the FTSE 100 constituents, where around 70% of earnings are derived from overseas and much of that from the US. So a weaker sterling should in theory benefit dollar earning companies whose profits become more valuable on repatriation.
And it can also benefit companies that pay dividends in dollars. Some UK companies do that. So a stronger dollar, a weaker pound, then when it translates back to sterling, it does give the dividends a boost. For fund investors that are, looking to try and mitigate currency risk, there are some, I say some, there's a very small number of overseas funds that come in special versions that strip out changes in the exchange rate. So they're called hedged share classes. And how they work is they have identical holdings and they have the same fund manager in place. But the difference is that the currency hedging means that if you're a UK investor, then you'll see the same percentage rise in your fund as a local investor with no reduction. Or indeed, if the currency swing works in your favour, you're not going to benefit from that either. So what the hedge simply does is cut out the currency exposure, whether that's good or bad. However, one thing to bear in mind is that hedging costs money. So the annual charges for a hedge share class, they are typically higher, normally around 0.1 to 0.2 percentage points higher. However, as mentioned, there's not that many fund firms that offer hedged share classes. Personally, in my view, I'd like to see more of it, but for whatever reason, there's not that many available, but there are some. So Richard, next up on your predictions is inflation. So I think a couple of months ago, it's fair to say that the consensus view from commentators and certainly from managers I spoke to appeared to be that the inflation battle had potentially been won and that inflation had become more than under control. However, the return of Donald Trump to the White House this month has potentially changed that narrative.
Well, absolutely. Should he deliver his campaign rhetoric, we could see inflation moving higher, potentially mainly through tariffs, which we'll come to in a moment. But just by way of reminder, tariffs are paid by the importing company and not the company which is looking to export those goods or indeed services. And if you ally that to the fact that he's looking for tighter immigration measures and indeed tax cuts, all of those things traditionally could rekindle inflation at a time when the battle had seemed almost won. Now, the other thing, of course, is that such pressures could surface almost immediately, which would imply that we could look to see potentially an inflationary spike as early as the second quarter of 2025.
And of course, if predictions for higher inflation do come to pass, then this would not be good news for bond investors. This is because central banks will become more reluctant to cut interest rates. Although I have seen some bond fund managers point out that given that Donald Trump does tend to link his political performance to the growth of the stock market, then he's not going to want to see high levels of inflation, because this would be bad news for both bond markets and stock markets. We saw that play out in 2022. So Richard, next up on the acronym is growth. So what's your thoughts on the outlook for growth in 2025?
It could well be that we see something of a mirror of what we've seen in 2024, in as much as the president-elect is very likely to be US-centric in terms of his measures to boost domestic growth. And of course, that's on top of what has already proven to be a pretty robust US economy. So if we have a strong consumer and manageable levels of unemployment, recession risks have been totally reduced. And of course, investors have been chasing growth, particularly through mega cap technology shares, as we've mentioned. But a rising tide could lift all boats, and that includes those companies further down the food chain, where we have been seeing some buying interest towards the end of 2024. I think in the UK, the growth potential is perhaps more nuanced. While the economy could suffer from both the measures announced in the budget, let alone any tariffs coming from the US, we continue to mention that the UK market is still being seen as having room for appreciation. It's undemanding valuation levels, and of course the raft of strong, stable companies with relatively high dividend yields has yet to be fully recognised. Now, of course, that's been the case for some time, but the day of reckoning may well be edging nearer, particularly if we get a repeat of 2024, where volatility elsewhere results in something of an overseas investor move towards the perceived defensive status of the UK market, as evidenced earlier this year when, again, as we mentioned, the FTSE 100 in fact hit the record level back in May.
Next up is interest rates. So at the time of this recording, interest rates in the UK are at 4.75%. Interest rate expectations can change very quickly. But at the time of this recording, I saw a recent interview with the Bank of England Governor Andrew Bailey with the Financial Times. He said that for 2025, he expects 4 interest rate cuts. So if that rings true, that could take UK interest rates to around 3.5% or 3.75% by the end of 2025. What's your view on interest rates?
Well, I think the general thing to say there, of course, is that borrowers would hope so, perhaps savers slightly less. And just by way of reminder, really, higher interest rates, of course, do make it, and this is something that applies particularly in the US, do make it more difficult to justify higher valuations, because they reduce the present value of future profits, quite apart from the fact that smaller companies, for example, which rely on borrowing to grow their businesses, are less likely to do so at higher rates. That's why that was such a theme for 2024, the likely downward path of rates, which we began to see. But expectations for the pace of rate cuts in 2025 have already been dialed back, particularly in the US. It remains to be seen what happens in the UK, for slightly different reasons, but both connected to a resurgence of inflation. UK budget measures such as the increase of national insurance contributions, of course, already widely bemoaned in industry, could yet filter through to higher inflation, which could mean that the interest rate picture rather changes. And of course, any increased cost passed on to consumers would be inflationary. And certainly in the US, the potential for new inflation and interest rates remaining higher for longer, as the Fed has said in the past, is not a mantra which investors will be wishing to hear.
So next, we've already spoken about the prospect of potentially higher inflation under the incoming next US president, Donald Trump. So I think this may be part of your next prediction, Richard, which is tariffs, Trump and trade wars. Please talk us through.
Yeah, I mean, again, we're talking pre-election rhetoric, and we know that Trump is a negotiator. So it may well be that some of these figures he's pitching particularly high, just as an opening gambit, if you will. But yes, he has said he intends to introduce whinging tariffs on imported goods, which he thinks are essential to reduce food prices, for example, the federal deficit, and also boosting domestic manufacturing. Now, the ones that he has threatened so far range from 20% tariffs to Europe, where, of course, that would be a large impact in the UK because that's our second largest export destination, 25% to Mexico unless the illegal drugs flow is stemmed, and 60% to China, where relations are already fractious, of course. As I say, these could be an opening gambit, but it does give you something of a clue as to what he is thinking. And in any event, progress on these tariffs, we've got to look out for some of the consequences on that, such as, quite apart from the inflationary impact, the pressure that could be put on supply chains as importers and exporters look elsewhere, let alone whether it could effectively derail the Federal Reserve's plan to reduce interest rates at a fair clip.
Next up on your list of things for investors to watch out for in 2025 is, of course, artificial intelligence, AI. Clearly couldn't be ignored when you were putting that together. So you've positioned it as AI reckoning or more to come.
And I think we will continue to do so. The thing is that mega cap tech stocks and Nvidia, which is very much the poster child at the moment, have quite simply continued to confound expectations. What we're seeing is a bar which is raised on a quarterly basis in terms of expectations for earnings and, of course, profits. And we continue to see equally companies smashing those particular expectations. I mean, Nvidia shares, just in terms of 2024, up by almost 200%. The further you go back, the more astounding those returns get. By the same token, of course, and despite the confounding the critics, it has propelled several mega cap stocks. But of course, this comes with some danger that on a quarterly basis, should any of these companies fail to meet those rising expectations, we could see some air let out of the tyres rather quickly. That being said, we've not yet got to that point of equilibrium where we can accurately price just what the impact of AI might be to these individual companies. It could also be, of course, that maybe to a smaller extent, AI results in some takeover activity. It's the comparison there would be with a pharmaceutical company, which rather than running its own massive research and development unit, which they used to do, they pick off specialists in certain pharma areas. And you could see that extending to AI, where a company may wish to get up to speed, if you like, and potentially pick off some AI specialists further down the food chain.
And as mentioned in the last episode of 2024, when we look back at the year, I think over the medium to long term, you have to make a very contrarian call to bet against the US stock market. However, I do think some investors are becoming increasingly concerned about potential concentration risk for the S&P 500 index. Those Magnificent Seven stocks account for around a third of that index now. And as mentioned in the previous episode of this podcast, for investors that are concerned about that concentration risk, then one of the options to consider are equal weighted index funds or ETFs. Two of them on our platform are Invesco S&P 500 Equal Weight ETF and Xtrackers S&P 500 Equal Weight ETF. And I also think as well that if you do own an S&P 500 index fund or ETF, then if you're looking for active managed exposure, then personally I'd be looking for something that's completely different from the composition of that index. I'd be looking for an active fund that is very underweight the Magnificent Seven, so that if those shares do suffer a correction, then that active fund can potentially add value for you. One of the most well-known funds that is sort of betting against big tech is Fundsmith Equity. It has some exposure to some of the names in the Magnificent Seven, but it does have a low allocation to technology shares overall compared to the index and compared to other global equity funds, which makes it somewhat of an outlier. We had Terry Smith on the podcast for our 100th episode, which took place in September. If you've not listened to that interview, I would urge you to go back and have a listen. There's some really interesting insights from Terry Smith. He explained why he's not bought Nvidia, and he also gave his views on the Magnificent Seven as a whole and how the Magnificent Seven's performance has made it harder for active funds like his to outperform the index, given how narrow the stock market rally has been over the past couple of years with those 7 stocks dominating. We're now going to end on the last prediction, which is large caps versus small caps. So Richard, please do talk us through it.
Well, that's a great backdrop you've just given, because certainly some of the recent comments around the US market has been whether those mega cap technology stocks, the Magnificent Seven in particular, have actually been sucking life out of its own market, let alone other global markets where the hunt for growth has clearly been not only concentrated stateside, but rather more concentrated in those 7 stocks. And it begs the question, we've spoken about what may or may not happen with AI this year, but it begs the question, if we've got a domestically focused president who's looking to boost his own economy, that rising tide will probably lift all boats. And we've already seen some bargain hunting further down the chain from investors who are starting to just consider other investment opportunities in terms of moving away from technology per se. I think in the UK, any such boost for mid and smaller cap shares is likely to be on a valuation basis, should that re-rating ever come, of course. But more broadly, I think it's also interesting that recent bank results have shown something of a return to deal making. In other words, M&A and indeed new issues, IPOs, etc., which has boosted their investment banking returns. The obvious UK example being Barclays. In terms of the potential tariffs, we've already spoken about US and China. US companies with supply chains in China could mean that there's something of a positive benefit for smaller and mid-cap companies if that focus is going inwards rather than outwards. And finally, I mean, in the UK, according to a PwC report back in July of 2024, the first half of the year saw £68 billion of M&A in the UK, which was an increase of 2/3 from the previous year, far outstripping global activity. And although there was something of a relative decline in the third quarter, 435 companies compared to 479 the previous quarter, the well-recognised cheapness of the UK market, which we've been talking about, could yet result in approaches for UK companies at current levels turning out to be the thin end of the wedge.
And for investors looking to play a potential recovery for the more domestically focused stocks in the US, you could, of course, seek out a index fund or an ETF that is investing in that part of the market. There are a number of options. And in terms of actively managed funds, the US smaller company fund that's on Interactive Investor's Super 60 list is Artemis US Smaller Companies. So it's been managed by a fund manager called Cormac Weldon since the fund was launched in October 2014. And it's style agnostic, which means that, it'll invest in both growth and value stocks. Although, according to our analysts, the strategy does tend to have more of a growth style bias overall. So that's one potential fund to check out as part of your wider research. And in terms of the UK, again, you could seek out an index fund or an ETF that is tracking the UK smaller company part of the market. And for actively managed funds for the UK market, we've got Henderson Smaller Companies on the Super 60 list. This has been managed by Neil Herman since 2002. Since launch, it's got a strong record due to the process and the growth-biased stock-picking approach. Another potential option in the Super 60 list is Fidelity Special Values. So this investment trust, it invests across the UK market. However, it does tend to have a bias towards the small and mid-cap businesses. And, it's this part of the market that, as mentioned, is looking attractive in terms of valuations and to play a potential domestic recovery. It's managed by a fund manager called Alex Wright, who has a contrarian approach to finding value opportunities across UK companies. My thanks to Richard, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like to talk about via email, on OTM at ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website at ii.co.uk. And I'll see you next week.